Namaste. In this video, we'll discuss about Indian Accounting Standard 36 that talks about the impairment of the assets. The objective of this IND is to ensure that assets are carried at no more than its recoverable amount and how the recoverable amount is determined. This IND does not apply to inventories, assets from construction contracts, deferred tax assets, assets from employees benefit, biological assets, insurance, contractual rights under insurance contracts, assets held for sale, and financial assets instrument. This IND AS applies to land and building under IND AS 16, investment properties, intangible assets, goodwill, subsidiaries, associates and joint venture. Those are covered in IND AS 27, 28, 31. And assets, those are carried at revalued amount. So next question is what the impairment is. When the carrying amount of any asset is higher than the recoverable amount of that asset, this situation is called impairment of asset. Carrying amount in accounting records means the acquisition cost of the asset minus the accumulated depreciation or accumulated amortization, and the remaining amount is called carrying amount. Recoverable amount is the fair value minus cost to sale of asset or value in use. This concept we will discuss in coming slides. So when the situation arises that carrying amount is greater than the recoverable amount, difference between carrying amount and recoverable amount is called impairment loss. Now next question arises, what to do and or how to find out that our assets are impaired. So in this case, India suggests that end of each year we need to check about the indicators of impairment. These indicators may be internal or it may be external sources of impairments. So if there is no indication of impairment, we are not supposed to do the test of impairment, but in case the indicator of impairment presents, whether it is a external evidence or internal source of indication, in that case we need to perform the test also every year. There are some exception to the rule. In these cases we need to perform test every year whether there is a presence of indicator or not. In case intangible asset with indefinite useful life, intangible assets that is not available for use, and goodwill that is acquired in combination, in three cases we need to perform annual test for impairment. Their rule will not apply in respect of performing test in case of presence of indications of impairment only. What should be considered as red flag for presence of indicators of impairment? So as we discussed in previous slide, there may be external source of indicators, there may be internal sources of indicator of presence of impairment in books of account. So we need to consider both external as well as internal sources of indicators. In case of external source of indicator, there may be decline in market value, significant changes in market, technology, legal or at economic front, or there is increase in interest rates. If carrying value is more than the market capitalization for entity. In case of internal sources, there may be obsolescence or physical damage to the assets, significant changes or restructuring that will affect the cash inflow of the entity, or internal reporting evidences that suggest presence of impairment of assets. In case we have observed any presence of indicator of impairment, in that case we need to perform tests to check whether carrying value of asset increase the recoverable amount. So now question arises what the recoverable amount is. India says that recoverable amount is higher of assets or cash generating units, either fair value less cost to sale or value in use. In case any of these two, fair value less cost to sale or value in use, is greater than the carrying value, in that case, we are not to suppose impairment the asset. In this case, we are not supposed to calculate every time fair value less cost to sale or value in use, both the things. If any of these two is higher than the carrying value, we are not supposed to impair the asset. So how to calculate the fair value of asset? There may be best evidence for fair value is any binding sale agreement or active market to sell the asset, deducting the cost to sale, or availability of recent transactions that has happened, or any other best available information to find out the fair value of the asset. In case entity is not able to find out by any method the fair value less cost to sale, in that case it will consider value in use as recoverable amount. Let's understand how to calculate value in use. Value in use is present value of expected cash flow to be derived from assets or cash generating units. Expected future cash flow will be aggregate of cash flow to be generated from usage of asset and its disposal of it. Once we have derived the cash flow from usage and disposal of the asset, then we need to apply appropriate discounting rate to come on the present value of the cash flow. Based on the performed test on the assets, if we have determined that the recoverable amount of the asset is greater than the carrying amount, so difference between the carrying amount and recoverable amount will be booked as impairment loss. The treatment of impairment loss that has been arised will depend which model we are using to book the assets. If we are following cost model, in that case, impairment loss will be debited and assets will be reduced by that amount. If we are following revaluation model, in that case, to the extent we have revaluation surplus in our books, it will be debited and assets will be credited. And if there is a deficit in the surplus, revaluation surplus we have available, the remaining amount we will debit in the P&L. And the remaining amount of asset will be depreciated in the remaining life of the asset. There may be cases where recoverable amount of an individual asset cannot be determined. It may be because asset's value in use cannot be estimated too close to its fair value less cost to sale, or the asset does not generate cash inflows that are largely independent of other assets. In that case, to identify impairment, we need to group the assets. And if carrying amount of that CGU is greater than the recoverable amount, we need to book impairment loss. To identify CGU, we have to follow the consistency. Unless or otherwise, we can determine the change in the assets grouping in CGUs. We have goodwill, and goodwill shall be allocated among CGU or group of CGUs, and at the time of allocation of goodwill in CGU and group of CGU, we need to check that it will be allocated at lowest level that is identified for monitoring of goodwill in entity, and no longer than the operating segment should be considered for the purpose of allocating of goodwill. And the operating segment we have to check as per IND AS 108. topic is corporate assets. Corporate assets are contributing for future cash flow generation for CGU, under review or other CGUs. The character of corporate assets are that they do not generate cash inflows independently of other assets or group of assets, and their carrying amount cannot be fully attributed to the CGUs under review. So in this case, we need to identify corporate assets related to CGU under review and to allocate portion of carrying amount of corporate assets to carrying amount of other CGUs for the purpose of identifying the impairment loss. If we have booked impairment loss earlier, we need to check based on the external sources and internal sources about the increase in carrying value or fair value less cost to sale. So there may be cases of reversal of impairment. Indication of external sources and internal sources we have already discussed in previous slide. So in case of impairment reversal, it will be reversed if and only if there has been a change in the estimates used to determine the assets recoverable amount since the last impairment loss that was recognized. We are not supposed to reverse the impairment loss that we have recognized in respect of goodwill. And the reversal cannot result in carrying amount higher than the original carrying amount that would have been derived after regular depreciation if no impairment loss would have been charged. So this is all about summary of Ind AS 36, impairment of assets. Thank you.